In the last couple of days, I've had several homeowners contact me interested in refinancing their home, but discouraged because they thought that they had to write a check at closing to pay all the closing costs out of pocket. And nothing could be further from the truth. So in today's training, I want to talk to you about the different ways that you can use to pay closing costs when refinancing your mortgage. Hi, it's Robert Weinberg, and on this channel we empower people to take control of their futures through expert mortgage and financial strategies. In this training today, we're going to talk about how to pay closing costs when refinancing your mortgage. There's a lot of misconceptions about this out there, so I wanted to show you exactly what the real deal is. So first, let's talk about what types of closing costs you're going to pay when you're refinancing your home. So they're really going to come into three different types. You have your origination costs, which are the cost to underwrite the mortgage, process the mortgage, and if you choose to pay points to buy down your interest rate. There's also going to be title, settlement, and recording charges. Now, these are the charges that are going to be going to the attorney or the title company for them to do their title search, title insurance, and recording charges that will be to the town or the city in order to record the new mortgage. And last but not least is going to be escrow deposits. Now, these are the deposits that will go into your escrow account on the new mortgage to pay for your property taxes, your homeowner's insurance, and if applicable to your property, the flood insurance. So those are the different types of costs that you're going to incur. Now, the first option that you have is to pay out of pocket and write a check, but pretty much nobody does that. But that is what most people that are refinancing for the first time have told me that they think they have to do, is write a big check at closing for thousands or sometimes even tens of thousands of dollars for all of these costs as outlined above. So that's option number one, most people don't do. Option number two is to roll these costs into the new mortgage. Now, what that's going to do is it's going to increase the principal balance. So just for example, if you owe $300,000 on your current mortgage principal and there's $10,000 in closing costs, then it would increase the balance to $310,000. Okay, why would that make sense? Because then you don't have to pay anything out of your own pocket, and it just increases and goes into your monthly payment, and it is amortized over the term of the loan, whether it's a 20-year term, 30-year term, or whatnot. So that's definitely a common option. And last but not least is going to be lender-paid closing costs. So this is where you can take a higher interest rate, and in exchange for taking a little bit higher interest rate, the lender will chip in to pay your closing costs. Now, this may be something where it will pay a portion of your closing costs. It's not normal that lender-paid closing costs will take care of all of the closing costs, but it could take care of, a third, half, or even 3/4 of these closing costs. So an example of this would be if you qualify for a 3% interest rate, but then you get a 3.25% interest rate. By taking that 0.25% higher, the lender can do a rebate back to you and actually pay, in this example, let's say 1% of your loan amount into the closing costs. So in the $300,000 loan, 1% would be $3,000, and they could give you a credit for that at closing, which would reduce the amount of closing costs that you would need to take care of using one of these other methods, either writing a check or rolling into the new mortgage a smaller amount. So what you really need to look at when refinancing, and as we've talked about in other lessons, is what's the cost versus the benefit? What is it going to cost you to do this, and what benefit are you going to receive as a result of the refinance? So if you're only going to save, let's say, $50 a month, does it make sense to pay $10,000 in closing costs to save $50 a month? Absolutely not. So what I do with my clients is a cost versus benefit analysis, or a break-even analysis, where we figure out how much your closing costs are going to be versus how much you're saving and what the break-even point is. Now, typically speaking, you're going to want to break even in no more than 3, maybe 4 years, but typically less than 3 years. And really what's going to determine the timeline of the break-even analysis of what you're going to want it to be is how long you plan to stay in the house. So if it's going to take you 3 years to break even on closing costs, but you're only going to be in the house for 2 years, then it doesn't make sense to move forward with the refinance. On the other hand, if you plan on staying in the house for a very long time, maybe 10 years, and it's going to take you 4 years to recoup the cost of refinancing, then it might make sense to actually proceed. You're going to want to consult with your mortgage advisor on this and have them run an analysis for you. You're going to want to review the loan estimate. That's a document that they're required by law to provide to you within 3 business days of your loan application. That loan estimate document will give you the breakdown of all of these costs, or at least estimates on all of these costs, so you know exactly what you're working with. Now, a lot of people ask me what's the most common, and I would say by far, without any question, it is most common just to roll all the closing costs into the new mortgage and increase the principal balance. What you need to also understand is that these escrow deposits, even though you do have to pay them up front with the new mortgage, you're typically going to receive a refund of your current escrow account, so it usually ends up being a wash or very close to a wash on those escrow deposits with the money you'll get back from your current mortgage, as long as you escrow right now. And we've talked about that in some other lessons of how escrow refunds work and whatnot. So reference that other video if that's something that you're interested in learning more about. So again, most common strategy is to roll the cost into the new mortgage and just increase the principal balance. The only out-of-pocket cost typically that's going to be paid, regardless of which strategy you choose, is going to be the appraisal fee. So if there's going to be an appraisal required on your home, that's typically going to need to be paid out of pocket, and that could be anywhere from $300 to $500, maybe $600, just depending on the type of property that you have, single family, condominium, multifamily, etc., and whether the property is a primary home, an investment property, or whatnot, and also what state you're in. So certain states have higher appraisal fees than other states. So hopefully that gives you some insight and helps you understand the different ways, the different options that you have to pay closing costs when you're refinancing a mortgage. If it's your first time here, please go ahead, hit the subscribe button, and also click the bell so you get notified on all of our future content. If I can be of assistance to you or anyone that you know looking at refinancing, feel free to reach out to my office directly via call, text, or private message. We'll talk to you soon, and take care.